And our own Andrew McCreath told us this week that Calgary is abuzz with talk of Lukoil, the giant Russian energy producer, perhaps buying in to Canada, acquiring a company called Velvet Exploration as part of a possible play to become huge in the Montney. Politically, how do you think that would be treated by Ottawa in particular, the Russians coming in to our energy patch?
Yeah. I honestly don't know. You'll have to ask them. We just stick to our knitting and what we're doing. So I haven't seen that transaction formally announced either.
What do you think, though? Do you think that's plausible that the Russians would want to take a look at Canada?
Potentially. I mean, there's a lot of gas in Russia too, and so yeah. I'm not sure what the long-term plan. Maybe it's part of a diversification exercise. But honestly, you'll have to ask them. So I'm not even remotely aware of that transaction. So
now after we talked about that huge Jupiter acquisition you did last year, worth more than $600 million. So that has left you with a lot of inventory. And you said, I think, that you have the most drilling inventory of any North American gas company right now. So you must be keen to find outlets for that gas. Now, I know you're optimistic about LNG Canada, LNG exports from this country, but that's going to take about 3 or 4 years to build, isn't it?
Yeah, well, LNG Canada, that project is underway and its associated Coastal Link pipeline. So I think, plus or minus 2025 is when that comes on stream. And so that'll be, very helpful for Canadian gas, because you'll pull, ultimately, if trains 3 and 4 are FID'd by the operator of that venture, it'll pull 4 Bs a day west away from AECO and Station 2, which is just going to be a long-term, very positive impetus for natural gas pricing.
And just to put that in context, right now, Western Canada is producing something like 15.5 billion cubic feet of gas a day. So extra demand of 4 billion would be pretty significant.
Yeah, and in the interim, the intra-basin build-out that's been going on via TransCanada will take that 15.5 to about 18.5 Bs a day by 2022. And it's partly done already, and it's a combination of increased export capacity on existing pipelines out of the basin and intra-basin demand increases. So, then we have really a 20% bump within the next 2 years in basin capacity or demand. And that's going to be very positive for pricing as well. We'd estimate that right now, because Canada's had lower for longer gas prices, so a lower gas-directed rig count for a longer period of time, supply, and it's hard to get it 100% accurate, but we're down about half a B a day year over year, but demand is also up. Structural demand half a B a day. So that 1 BCF a day swing kind of makes all the difference. And, what I'm saying is that it's not temporary and related to, 2 weeks of cold weather that we're having all through North America. This is pricing improvement for AECO and Station 2, for an extended period of time. It's really a structural change. And we've been waiting for it for a long time. I've been telling you for half a decade that gas prices are going to go up. So maybe I'm finally going to be right.
Good for you. And of course, I don't know I forget if you mentioned that coal. I mean, coal is on the way out in terms of electric generation. Yeah,
and the U.S. was ahead of us on that, actually. So they've retired a significant amount of their coal-fired electrical gen, and sure. Alberta is doing the same thing. And I think most of that will be done by the end of 2021, which, adds another half a B a day of intra-basin demand, and it all matters.
Mm-hmm. Now, Jeff Tonkin of Birchcliff told us yesterday that investors don't want to hear about growth at any price anymore. They want to hear about profits and debt. Is that your mantra too? Oh, yeah, sorry, you want to hear about profits and debt reduction. Yeah, go ahead.
Yeah,
sorry.
We grow at 5% per annum and generate an enormous amount of free cash flow, and we're using it for dividend increases, and that's returning profit and capital to shareholders, and continued debt reduction. So we'll end up taking our debt down to something like half a times debt to cash flow, which will probably be the lowest in industry. And we think that's the right thing to do. And we're not growing basin supply other than our 5% growth because we like this supply-demand rebalancing that's happened. So if we want to grow at more than 5%, we'll use M&A acquisitions to supplement that, at the right time, at the right place, and the right asset.
Your stock yielding about 2.5% right now. You never cut it. You never cut the dividend.
Nope, we didn't have to. We were in a strong financial position through 2020. And that comes from having relatively low debt to begin with and ample liquidity during the crisis. And as I mentioned, we didn't lay anybody off. We actually hired a few people. And we were the busiest operator through 2020. So we kept as many people as we could, not enough, obviously, employed in the service sector and in the small towns in Alberta and BC. So Dawson Creek and Fort St. John and Edson and Hinton and Spirit River. We tried anyway.
Yeah, is it hard to find people now? Good skilled people?
No, there's unfortunately the layoffs started before 2020, obviously in oil and gas, and so there's a lot of people out of work, and the prospects still aren't great. It's picking up a little bit, but we need particularly on the gas side. If you look at the curves, they're backwardated, so. 2022, the price still isn't particularly strong, AECO or NYMEX. We expect, because of the storage drawdowns on both sides of the border, that to incent drilling and growing supply a little bit, prices will improve in 2022.
Let's pull up a 5 or a 10-year chart of your stock there, Michael. Thanks for giving us this time. I mean, back in 2014, your shares were trading above $55. Now, they're about 29 right now. On a per-share basis, is your profitability and cash flow comparable to where it was in 2014? If you have that number to hand, or can you give us some kind of a comparison?
On a per-share basis, our cash flow is 4 times higher now than it was in 2014. So, we're happy how our stock price has improved from Q2 of 2020. But when you've got that 10-year chart up there, we got a long way to go. And I wish it was 29. It's only 23 today. So.
Oh, I'm sorry. I don't know where I got that. Yeah,
I like
23.
Your idea,
sorry. Yeah, okay, 23. So just to reiterate, your stock price is half where it was in 2014, but you reckon your cash flow per share is 4 times higher than it was back then?
Yep, that's true, and our reserves have grown even more than that. I think our reserves per share are up 7 times since then. So we've executed, but when you look at a stock price performance like that, I guess we haven't executed well enough for the shareholders, the ones that were there in 2014. So lots of work to do yet.